This is a test to see if you guys can hear me. All right, just seeing if you guys can hear me. All right, can you hear me now? Okay, good. Got that cleared up. And we will start in 3 seconds because it is now 11 a.m. All right, welcome everybody. I am Dan Romero and we are here for quarter one 2024 economic review. So we're going to take a look of things that have happened and where we kind of see things going forward. So let's get this cooking here. I'm on a new computer, just upgraded everything. So everything's a little quirky, a little bit off, but we'll try and get this going good. But ultimately, at the end of the day, I say this each and every time we have a presentation, but honestly, our best client is an educated client. So we want to make sure everybody is up to snuff. So we want, as it says on the screen in big, bold letters, knowledge is power. And so we want to keep our clients and our 401k plan participants really up to speed with everything that's going on out there. So first things first, let's talk about how 2023 ended, 2024 started, and the market really did well last year and continued to do well this year. We saw a little bit of a pullback in April and May, and now the market is resuming its upward trajectory. So it's been really nice returns here, where you can see the Dow Jones Industrial did over a 5% return, and the S&P 500 did closer to a 10% return. So pretty good. Everyone's generally pretty happy with what's going on in the markets right now. So again, a little bit of a pullback in the second quarter, but we're starting to see that work its way back. Now, what's been the highlight of the last couple of years has been interest rates. And so this just gives you an idea of the type of movement we've seen going back to July of 2000. The Fed had target a rate of 4.25%, 5.25%, 5 to 5.5%. And then we've kind of seen stabilize for a bit here. So this is all going to be driven by the inflation numbers here. And so going into March, the overall inflation numbers were about 3.5%, with core coming in at 3.8%. Inflation had moved down in a pretty good way. It's starting to tick back up again in the most recent meetings, announcements, I should say. So inflation continues to be a little bit of a bugaboo for us. But that leads us to what the Fed is doing with regards to interest rate hikes. So you can see here, this goes back to 2022, December, that the Fed was towards the tail end of its aggressive hiking. We held steady in June of 2023 and then had one more hike last July. But we have not seen a rate hike in the last 5 meetings, actually 6 meetings, because April, May has occurred already. So June meeting will be the next one, and we'll see. The talk was that the Fed would be lowering rates this year. That would be good for long-term bonds if that were to happen. But right now, with inflation going back up, we may not necessarily see that. So for those of you that have bonds, you should continue to see some stability on that part, where when rates were going up, we saw a lot of instability. And so I'll jump into that, why that is. So bonds traditionally are going to be used in a portfolio to bring stability, to bring it so that you don't have as much rock and roll as you could do with the stock market, because essentially you're loaning a company or a municipality or the U.S. Treasury money, and they're paying you back an interest rate. So as you can see on the screen here, as it pertains to interest rates, that when interest rates go up, the price of bonds go down. And so why is that? So let's go back to 2022, when rates were basically zero. Maybe you had a treasury bond that was paying 1.5%. Well, if rates go up to 5%, your treasury bond, you're still going to get paid your 1.5%. And if you hold it to its duration, to its end date, then you'll get paid your money back. But if you needed to sell it, no one is going to want to buy a bond paying 1.5%. if there is a current bond on the market that's paying 5%. So if you really wanted to sell it, you'd have to discount it. And so that's why we saw bond prices fall drastically on the long-term end in that 2022 increase all the way into 2023. Now, inversely to that, you can see, should interest rates start going down, we would expect the price of bonds to go up. Again, if you're sitting on a 5% bond and rates fall to 4, then your 5% bond becomes more attractive to a potential buyer out there. So anytime you see rates go up, expect the value of intermediate to long-term bonds to go down, and vice versa if interest rates go down. So if you have questions about that, there should be a little deal on Zoom here where you can ask questions, and then I will talk about that. I'll answer those towards the end of the presentation here. But you look at this, and we see where yields are right now. So 5-year at 4.21, 10-year at 4.2, 30-year at 4.34. Well, this is as of March. They've been pretty stable since that period of time. But again, we continue to monitor this and see where things are working. So that's where yields are at. Now, money market rates, if you aren't aggressive with it, if you're just keeping your money in the bank, you're probably not getting paid a whole lot. I'm surprised to see this, but the average 12-month CD is at 1.95%. That means there's a lot of laggards out there. So you should be able to do much better than that for those of you that have money in cash right now. There's no reason you couldn't find CDs in the north of 5% and money markets and things like that. So things where we've been helping out people with are going into treasury bonds and municipal bonds. The benefit there is that treasury bonds and municipal bonds can have certain tax benefits. So if you do have money in the bank, that's certainly something good to talk to us about. So again, are we in line for a possible correction? Well, you know, a correction would be a decline of 10% or more in any type of security or asset. Now, there's a lot of things out there that could lead us in that direction. So we've seen uncertainty around the globe. There is unemployment numbers that don't look attractive, but there are a lot of things that are still going well. And we are seeing good earnings returns for these various companies, which continues to drive the stock market up. But let's just take a look at the history of when the market goes up 10% or more in the first quarter. So this chart here will show you at the bottom here, you see Q1 2024, that we did over 10% in the S&P 500. So historically, the next quarter returns are positive and year-to-date are positive. You can see there's really only been a couple periods of time where we have seen a 10% positive return in the first quarter with a decline thereafter. So that does speak pretty positively that we should be in for a good remainder of the year here if we're just looking at the history of things. But with that said, don't be surprised if we see a pullback or a retreat of anywhere from 5 to 10%. Like I said, we kind of experienced that already in April and May, where the S&P 500 did pull back in a pretty good way, but is working its way back. So just some numbers to consider. So again, what's going on around the world right now? There is uncertainty because we have all the tension in the Middle East and everything that has been happening over there. We still have the Ukraine world. China is always a bugaboo on the radar screen here. And of course, we are in an election year, not only just the presidency, but there's a lot of key Senate and House races that could potentially impact tax law and other things. So, you know, the Trump tax cuts that were passed in his first term are scheduled to sunset in 2026. So if nothing happens, if the government just sits on their hands, then we're all going to see a pretty significant tax increase in 2026. So that's something to really consider. So as it pertains to what we're doing down here, again, we're looking to be proactive. We're trying to utilize a lot of investments or work into the portfolio that can help protect you should things go south. And this has to do with our active managed portfolios. For those of you that are in 401k plans participants, those are going to be self-directed accounts, and we wouldn't necessarily have those type of tools available. But there are things that we can assist you with if you have questions about that for your money that is in a 401k plan. But for the folks that we can actively manage accounts for, we are trying to be cognizant of the fact that we have these various issues going on. And so we want to be proactive to make sure the portfolios can withstand any type of downturn. So always continue to proceed with caution. There's continues to be as much uncertainty as we've seen now as any time. And so we'll continue to stay the course, but really long-term investing strategy, stick with it, you'll be good. If you get emotional or try to make decisions that are a little bit off the cuff, that's where people can get into trouble. But some key takeaways for today: inflation is still a concern. It had tapered and now it's starting to work a little bit way back up. If it continues to go that route, then who knows what the Fed will do? Will they raise rates again? I don't know, but they may not necessarily cut them. An inverted yield curve remains. We looked at that. Fed did indicate 3 rate cuts in 2024. I'm not as optimistic about that. So we'll see. There are some issues that could bring a market correction this year, like we talked about, and volatility is going to remain while things continue, do well. We're going to see these continuous ups and downs. So stay focused on the long term and pretty much be prepared. So appreciate everybody joining us today. Again, best compliment you give us is an introduction or referral. So if you know anybody that you think might want to be in our mailing list or potentially even attend a presentation like this, pass their name on. We'd love to have them here. And also or if they're just looking for a new financial advisor, we'd really appreciate that when you're able to help us on that front. But ultimately, at the end of the day, the most important part of this presentation is going to be compliance. So study this closely. And I am available for questions if anybody got anything. So go ahead, let me see here, and I think the chat is where that might show. So if you do have a question, feel free to toss it at us here, and I'd love to help you out. Okay. That is going to wrap it up for today. If you have a question that pops up after this end, just give me a call or drop me an email, or you can even send us a text now, and we'll get back to you. So I appreciate all of you. You're fantastic, and looking forward to speaking with you again. We'll do a year-end outlook, maybe sometime in September or October, just to kind of wrap things up. And then we'll keep you posted on anything else we got going on. But I appreciate you being on. Hit me up with any comments or questions. Take care.